Hi everyone, this is Yazad. In today's video, we are going to look at a strategy through which you can make a return of as high as 83% on a short-term investment by participating in the TCS buyback. Now note that this is a short-term trade based on some assumed calculations and it does involve a minimal risk. Tata Consultancy Services has fixed February 23, 2022 as a record date for the purpose of determining the entitlement and the names of the equity shareholders who shall be eligible to participate in TCS's share buyback. In January this year, the company had announced its biggest share buyback in the last 5 years of Rs 18,000 crores at Rs 4,500 per share. Now, a share buyback is a corporate action to buy back its own outstanding shares from its existing shareholders, usually at a premium to the prevailing market price. TCS is the largest IT company in India and also the world's largest provider of IT services. Retail investors with a long-term positive view on TCS and its financials should ideally hold the stocks and not tender them now. However, short-term retail investors could potentially benefit from a trading opportunity by tendering their shares in the buyback and earn a return up to 83.07%. Sounds interesting? Keep watching to find out how. TCS share buyback, a short-term opportunity for retail investors. Now, at the onset, let us be clear. This opportunity is for retail investors only, that is, small investors holding up to Rs 200,000 worth of shares of TCS. Now, the quota for retail investors is always reserved at 15% of the total buyback for any company. Hence, of the 4 crore shares being bought back by TCS, 60 lakh shares will be earmarked for retail investors. If we look at the past 3 buybacks, in 2017, when TCS announced its buyback at Rs 1425, the market price at the time was approximately 1,250, meaning that the company offered its shareholders a premium of 14% to the market price. Similarly, in 2018, TCS offered to buy back shares at 2,100 as compared to the market price of 1,850, that is a premium of 14%. Again in 2020, when TCS announced a buyback at Rs 3,000, it was at a 10% premium to the market rate. Now at the current market price of 3,735, that is yesterday's close on the BSE, the premium is the highest at 20% with the buyback price fixed at Rs 4,500. So does it simply mean that a retail investor can just buy shares worth 2 lakhs at Rs 3,735 and sell at Rs 4,500 and pocket the difference as a profit? Alas, it is not that simple. Now this is where the entitlement ratio comes into play. Entitlement ratio gives the indication of minimum shares that will definitely be accepted in the buyback. It is always calculated on record date. Now in the past, we've seen retail investors get 100% acceptance when they tender their shares in the TCS buybacks of 2017, 2018 and 2020. Further, the stock price of TCS touched its buyback price before the tendering period. However, let us take a conservative approach and assume that the acceptance ratio this time could be lower as majority of the retail investors are likely to participate. Now, we look at 4 possible scenarios using simple calculations to arrive at potential possibilities using a strategy to make money in the short term with minimal risk. Now, this could help us decide if it is prudent to take part in this short-term opportunity. Now, let us look at each scenario and determine the various outcomes. We start off by assuming that the price on record date is at Rs 4,500 per share. With the cap of Rs 200,000 for retail investors, an investor can purchase a maximum 44 shares, which is 200,000 divided by 4,500. Hence, at the current market price of Rs 3,735, our investment would be for an amount of Rs 1,64,340. Now, the buyback process is usually completed within 2 to 3 months. For the sake of this calculation, let us assume the period of completion at 90 days from the start of trade. Now, let's see the profit calculations based on the acceptance of shares tendered by investors. Let us begin by looking at the acceptance ratio of 40%. Now, assuming that an investor purchases shares at the current market price, which is as per yesterday's BSE close of rupees 3,735, and only 40% of his shares get accepted, the investor would make a profit of rupees 13,464 on the 18 shares accepted by TCS. This results in a return of 33.23% on his investment of rupees 1,64,340 over a 90-day period. However, this is not the final return. The investor still continues to hold the balance 26 shares which were not accepted in the offer. So what happens next? Now the price of TCS could go up further over the next few months, in which case the investor could sell the balance 26 shares in the open market and the overall return would be even higher. However, on the other hand, let us assume that the price of TCS drifts lower during the period of buyback. In that case, as per our calculation, the break-even price, that is the price at which one would make no profit or loss on this entire transaction, works out to rupees 3,225. This simply means because of the profit already earned of rupees 13,464 on the 18 shares tendered, the investor would not make any loss on the balance 26 shares until the price falls up to rupees 3,225. Now below that price, the investor would start incurring a loss on the entire trade and the strategy would have been a failure. However, looking at the fundamentals of TCS, its dominant position in the IT industry, and the management's confidence in their own stock, which is accentuated by the fact that the company is willing to buy back its shares at a high premium, indicates a low chance of the stock price falling that much over the next few months. However, seasoned investors know that there are no guarantees in the stock market. One has to make presumptions based on their own research and assessment. Now, based on the same working, we can see potential returns of 41.53% in case of an acceptance ratio of 50%. In this case, the break-even price per share of TCS is rupees 2,970. It's 58.15% in case of an acceptance ratio of 70%. Here, the break-even price per share of TCS is rupees 1950. The return is 83.07% in case of the acceptance ratio of 100%. In this case, the break-even price is not relevant as all shares are accepted by the company. This is, of course, a best-case scenario. Final thoughts on this. Shares of TCS bucked the market trend yesterday as the stock climbed over 1% following the announcement of the record date for its buyback offer. Now, this was in a sharp contrast to the 3% fall in the BSE Sensex. Investors may have bought shares hoping to tender them during the buyback and make a quick buck as seen above. The stock has already corrected significantly in the last month, creating a favorable risk-reward opportunity for traders and investors. Even if a retail investor doesn't tender his shares, he could potentially gain from the rise in the share price on strong fundamentals of a company that has been consistently rewarding its shareholders. This could be a good opportunity for short-term investors willing to take a well-calculated risk to make a good return on their money. That's all we have for this week. Thank you so much for watching. Happy investing. Goodbye.